Hello everyone, my name is Michael Lamont. I am the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And the reason why is because it's the best opportunity there is for any of us out there to exponentially grow our wealth and to ultimately attain financial freedom and to give our families and our children and our grandchildren what the things that they deserve, the things that we want to give them, and provide the life that we want to give them. So those are some of the reasons why I got involved in the stock market. But what I want to talk to you today about is about technical analysis. And I was having a conversation with a friend of mine about technical analysis, and he had thought that technicals are just something that matters in the short term. And as you hold a stock or an index or an ETF or whatever it is, technicals matter less and less. And if you're a long-term investor, then you don't need to worry about the technicals. And I believe that that's completely wrong. And I'm going to hopefully prove to him, and I'm hopefully going to prove to you that the technicals absolutely matter on a long term. And let's take a look at some charts. Okay, so the first chart that we have up is a chart of the NASDAQ. And this is a monthly chart of the NASDAQ that goes all the way back to 97 and up to present day. And so we could easily see here how the charts do matter and how technicals matter. So in March of 2000, that's when the NASDAQ topped, and it toppled, and it fell hard. Let's measure this move here. So if you were the unfortunate soul that bought on March 1st of 2000, and you decided that you were going to hold and that technicals didn't matter, you would have sat through a 78% decline, and it would have taken you 17 years to get your money back. So that's number one. Number two is if we draw a trend line straight across, connecting the top of that high, the former high, the 51.32 high set in 2000, in March of 2000, we could see that when the NASDAQ finally did rally and hit that level, it took, let's see, between July of 2015 until November of 2016 to finally begin breaking above that level and rallying. So it took a year and a half. Those are technicals at work. That's not just some magic number that got pulled out of a hat. That's the market consolidating around a major top, and finally taking a year and a half to consolidate and then break out above that level. So we could see it happening right there on the monthly chart. And another thing that's interesting too, and we see this on weekly charts and we see this on daily charts, is the character of the stock or the index. It changes over time. So we can see here as it's approaching that former high, and then the action becomes wide and loose, and the selling is happening, and people are worried around here that, oh, well, we're going to roll over again. But then it catches this longer term 40-month moving average, that black line. It reverses off of it. It's closing at the highs of the month, and then it finally starts to work its way back up towards that former what's now a former all-time high. And you can see the price action tightening up as we move to the right of the chart, and it's going from that wide and loose action where there's so much uncertainty and panic and selling to, just a tighter consolidation, more controlled movement, and then an ultimate breakout of that year and a half long consolidation, and since then it's been off to the races. Another point about monthly charts is how moving averages can work in our favor for these monthly charts. And I actually use this strategy to trade my own retirement accounts. So at work, I get a basket of mutual funds from Vanguard and TIAA CREF, and they all basically move in the same direction of the major indexes, NASDAQ, S&P 500 to one degree or another. So because the price action is so similar, I trade it the way that the indexes are trading. And so if you're above the 12-month moving average, then you can stay in for these big long-term moves. But when you cross below the 12-month moving average and you close below the 12-month moving average at the end of the month, then you can exit and avoid these major drawdowns. Like, for example, back in, when did it start closing? So the last time that it closed after the major top in March, so in September, it closed below that 12-month moving average. And so if you sold there rather than holding on, you would have avoided a 69% decline. And if you re-enter when the stock or the index or whatever it is that you're trading finally climbs back above the 12-month moving average and closes above it at the end of the month, then you're back in down here, and you're gaining an additional 36% on top of what you had originally saved, versus the guy that bought back here and just decided that they were going to hold and they're a long-term investor, so these technicals don't matter. So worked on the NASDAQ, the monthly chart. Let's take a look at a stock. And now let's take a look at GE and see how much the technicals don't matter if you are a long-term holder. So let's say that you're somebody that bought back here in 2000, or better yet, let's say that you saw it bottoming and rallying and you bought back here in March of 2005, right? GE is a huge company. It's not going anywhere. It's safe. It's stable. It pays us a dividend. So let's just buy that and let's hold it forever, right? So we bought it. We see that it obviously crashed in 2009, 2008, 2009, and all those people are still stuck underwater. But hey, this is a great company and it's not going anywhere. Well, it did rally, that it did, and there are people that traded it in 2011 that are doing well, and 2000, even up to 2016, if you're buying it in here, it has that a little bit of a longer uptrend, but already we see that it's rolling over, and since December of 2016, it's been rolling over and it's been drastically underperforming the market, and there's a whole bunch of people that are underwater in this stock right now. If you bought back here and you're one of these long-term holders, you're definitely not happy. We're finally getting close to breaking even, and now it's back to the drawing board. And if you're somebody that bought back in 2000 or before that, and this is a solid company that's not going anywhere, well, you're collecting a dividend. That's something. But we can do a lot better than just collecting a dividend, and basic chart analysis helps so much with that. And that's why we do what we do. So I hope that helped explain why technical analysis matters regardless of the time frame that you're trading. If you have any questions about it at all, please leave a comment in the comment section below and I will personally answer them. Also, take a moment, like this video, subscribe to our channel so that way you get all of our updates. And thank you all so much for watching. I truly, truly appreciate it. And I will see you again very, very soon.